Every recession follows the same pattern. It doesn't arrive like a sudden storm, but more like a subtle shift in the air, a change in pressure that only the most attuned observers notice at first. One moment, the world feels full of limitless potential. The stock market is climbing, businesses are expanding, and the prevailing sentiment is one of unshakable optimism. New technologies promise to reshape our lives, headlines celebrate record profits, and the path to prosperity seems clear and wide for everyone. It's a time of confidence, of spending, of belief in a future that will inevitably be better than the present. Then, the whispers begin. A major company announces unexpected layoffs. A key economic indicator, once a reliable measure of growth, comes in just slightly below expectations. The news cycle, once a steady drumbeat of good news, starts to feature words like headwinds, slowdown, and uncertainty. For most, this is just background noise, easily dismissed. The momentum of the good times is a powerful force, and the human mind is naturally inclined to believe that the trend will continue forever. But it never does. The pattern accelerates. The whispers become a conversation, and the conversation turns into a roar of headlines and breaking news alerts. The market, once a symbol of collective confidence, begins to falter. A dip becomes a correction, and a correction spirals into a crash. This is the moment the cycle becomes visible to everyone, and this is where the great divergence begins. Most people panic. It's a natural, deeply human reaction. Their life savings, their retirement accounts, the value of their homes, all of it seems to be evaporating in real time. The dominant emotion is fear. Fear of losing a job, fear of not being able to pay the mortgage, fear of an uncertain future for their children. This fear is amplified by a relentless media cycle that thrives on crisis. Every market drop is framed as a catastrophe, every layoff a sign of impending doom. In this environment, the instinct for self-preservation screams one thing: get out, sell everything, convert to cash, retreat to the sidelines, and wait for the storm to pass. It feels like the only logical thing to do. It feels safe, but it is the single most destructive decision one can make. While the majority is driven by fear, a few people prepare. This group isn't smarter by nature, nor are they immune to the anxiety of the moment. The difference is their perspective. They see the pattern not as a threat, but as an inevitability, and more importantly, as an opportunity. They have spent the boom years not by taking on excessive debt, but by building a fortress of liquidity. They have studied history and understand that economic cycles are as natural as the seasons. They know that winter always comes, but they also know that spring always follows. Their preparation is not about predicting the exact day the market will turn. It's about building a system that is resilient to chaos. They prioritize cash flow, reduce liabilities, and cultivate patience as their most valuable asset. While others are forced to sell their assets at fire sale prices to cover their expenses, this group is sitting on the one thing that becomes supremely powerful in a downturn: cash. And they wait. They watch the panic unfold, not with glee, but with a calm, calculated readiness. And the same group gets richer every single time. This isn't a conspiracy. It's a consequence of behavior. When the panic is at its peak, when the headlines are at their most dire, and when the average person is convinced that the world is ending, that is the moment of maximum opportunity. The prepared group begins to deploy their capital. They buy stocks in solid, world-changing companies that have been unfairly punished by the market-wide panic. They acquire real estate from distressed sellers at fractions of its previous value. They invest in businesses that others are desperate to abandon. They are buying fear, and in doing so, they are acquiring the future at a discount. This leads to the most misunderstood truth of economic cycles. Recessions don't destroy wealth, they transfer it. Wealth is not a finite pie that shrinks during a downturn. It is a current that changes direction. It flows from the hands of the impatient to the patient. It moves from those who are over-leveraged to those who are liquid. It is transferred from the panicked sellers to the prepared buyers. Think of it this way: for every person selling their stock portfolio at a 50% loss out of fear, there is someone on the other side of that transaction buying it, believing in its long-term recovery. One person crystallizes a permanent loss. The other plants a seed for a generational gain. The assets themselves, the shares of the company, the deed to the property, they don't vanish. They simply change owners. The dot-com bubble of 2000, the great financial crisis of 2008, the pandemic crash of 2020. Each event was unique in its cause, but identical in its outcome. In each case, the media declared the end of an era. In each case, millions of people sold their holdings near the bottom, locking in devastating losses and vowing never to invest again. And in each case, a quiet minority used the crisis to build life-changing wealth. They bought Amazon when it was dismissed as a failed .com. They bought bank stocks in 2009 when the financial system seemed on the verge of collapse. They bought Bitcoin and tech stocks in March 2020 when the world was in lockdown. The wealth created in the 2 years following these crashes dwarfed the gains of the preceding bull markets. But this wealth was not evenly distributed. It was concentrated in the hands of those who understood the pattern. This is the great paradox. Recessions have quietly created more millionaires than any bull market in history. Bull markets make people feel rich, as the rising tide lifts all boats. But bear markets are where the foundations of true lasting wealth are actually laid. It's during the downturns that the ownership of productive assets is reshuffled at bargain prices. So, why does this pattern persist? Why, after seeing it play out time and time again, do most people continue to fall into the same trap? The answers lie deep in our psychology, in the structure of our financial systems, and in the information we consume. In this video, we're breaking down this entire dynamic. We will explore precisely why most people are structurally positioned to lose during economic downturns. We will examine the specific strategies and mindsets that smart money employs to not just survive, but thrive. We will look at the historical data, separating myth from reality, and provide a framework for how recessions can be viewed not as a period to be feared, but as a rare window of opportunity. This is not a promise of easy riches or a guide to timing the market. It is an exploration of a timeless principle, that in moments of maximum pessimism, the greatest fortunes are forged. The goal is not to predict the future, but to prepare for it, to understand the game so you can choose how you play it. The coming chapters will equip you with the knowledge to see the patterns, to control your emotional responses, and to position yourself on the right side of the great wealth transfer. This isn't fear. This is history. And history, for those who are willing to listen, offers a roadmap. The word itself can send a shiver down your spine. Recession. It's a term loaded with anxiety, a forecast of impending hardship that echoes through history. From the Great Depression to the dot-com bubble, from the global financial crisis of 2008 to the sharp, sudden shock of 2020, each downturn carries its own story of loss and uncertainty. But why does the mere prospect of an economic slowdown evoke such a profound, almost primal fear in so many of us? The answer is simple, yet deeply unsettling. Recessions feel scary because they expose reality. During the good times, the boom cycles, a comforting illusion takes hold. The economy feels like an unstoppable force. Credit is cheap, jobs are plentiful, and the value of everything, from our homes to our stock portfolios, seems to only go up. We are encouraged to borrow, to spend, to believe that tomorrow will always be more prosperous than today. We build our lives on this assumption of perpetual growth. Then, the cycle turns. The first casualty is often the most personal: our livelihood. Jobs disappear. The positions that felt so secure just months before are suddenly declared redundant. Layoff announcements, once distant headlines, become immediate realities for friends, neighbors, and family. The search for new work becomes a desperate competition in a shrinking pool of opportunities. The psychological weight of unemployment, the loss of income, identity, and routine, is immense. It's the first crack in the foundation of the life we thought we had built. Simultaneously, the markets fall. The retirement accounts and investment portfolios that were a source of pride and security now become a source of panic. Watching years of savings evaporate in a matter of weeks is a gut-wrenching experience. The numbers on the screen, once symbols of a brighter future, now represent shattered dreams and a retirement that feels further away than ever. The financial media amplifies the panic, with every headline screaming about new market lows and deepening crises, making it feel like the floor is falling out from under us. As income shrinks and investments dwindle, the third pillar of the crisis emerges. Debt becomes heavy. The mortgage, the car loan, the student debt, the credit card balances, they were all manageable, even sensible, when income was stable and rising. But in a recession, this debt transforms. It becomes a crushing weight, an anchor pulling you under. Each payment is a painful reminder of diminished resources. The threat of foreclosure or repossession looms, turning the very assets that once signified success into sources of crippling stress. This trifecta of disappearing jobs, falling markets, and heavy debt creates a perfect storm of financial and emotional distress. But here is the critical insight, the one that separates those who are crushed by a recession from those who endure it. The fear doesn't come from the recession itself. Economic cycles are a natural, inevitable part of our system. There have always been booms, and there have always been busts. No, the true fear doesn't come from the storm. It comes from being unprepared. It comes from the chilling realization that the life you've constructed is fragile. Most people build lives that only work in good times. They build a financial house of cards, predicated on the best-case scenario, a stable job, ever-increasing asset prices, and easy access to credit. Their finances have no margin for error, no buffer for emergencies, no plan for a world where things don't go according to plan. When the economic winds shift, this structure cannot stand. It was never designed to. But there is another way. Smart money operates on a different philosophy. The informed investor, the prudent planner, the strategic thinker, they understand that winter is always coming. They don't fear it. They prepare for it. They build a financial fortress designed to withstand any season. They prioritize liquidity, manage debt wisely, and cultivate a mindset of patience and opportunism. They build for all cycles. This is not about predicting the future. It's about building a personal economy so robust, so resilient, that you are not merely a victim of economic cycles, but are in a position to navigate them, endure them, and even find the opportunities hidden within the chaos. This is the fundamental difference between fear and readiness. A recession is not the end of the economy. It's a reset. Weak businesses fail, over-leveraged people collapse, poor decisions get exposed, strong balance sheets survive, prepared capital expands. This cleansing effect is why recessions are powerful. The poor are hurt first, because they rely on one income, they hold no assets, they carry bad debt, they react emotionally. Recessions don't create these problems. They reveal them. The middle class does everything right. Good job, savings account, retirement plan. But inflation erodes savings. Layoffs erase stability. Markets move faster than wages. Without assets, effort alone isn't enough. Smart money prepares before the headlines. They reduce bad debt, build liquidity, strengthen cash flow, study history, wait patiently. They don't panic. They position. During booms, cash feels useless. During recessions, cash becomes power. Cash buys. Discounted assets, undervalued businesses, cheap real estate, fear-driven sell-offs. The wealthy don't hoard cash forever. They deploy it strategically. Every major fortune was built during uncertainty. Stocks fall, assets get discounted. Fear dominates headlines. Smart money buys when confidence is lowest. This is uncomfortable, but powerful. Fear overrides logic. People sell because they need cash. They panic. They don't understand cycles. Selling at the bottom locks in loss. Prepared investors don't need to sell. Crypto isn't immune to recessions, but it exists because of broken systems. Bitcoin represents scarcity independence, monetary discipline. Smart money treats crypto as insurance, Long-term exposure. Asymmetric opportunity, not a gamble. Recessions kill hype. Weak projects disappear. Strong fundamentals survive. This is why smart money reduces exposure, focuses on quality, avoids emotional bets. Jobs are fragile in recessions. Ownership endures. Businesses with real value survive downturns. Assets keep producing. This is why the wealthy prioritize ownership over income. Recessions don't last forever. Those who survive, buy patiently, hold discipline, avoid panic. Time rewards preparation. You don't need to be rich to prepare. You need financial discipline, reduced debt, long-term mindset, education, patience. Recessions reward those who stay calm. We have journeyed through the anatomy of economic cycles, from the dizzying heights of a boom to the sobering depths of a bust. We've examined the mechanics of fear, the psychology of the markets, and the practical strategies that separate survival from ruin. Now, we arrive at the final, most crucial understanding. Every recession, without fail, orchestrates a monumental transfer of wealth. This is not a new phenomenon. It is a fundamental law of the economic jungle, as old as markets themselves. It is a silent, often invisible redistribution of assets, of ownership, and of future prosperity. Think of it not as wealth being destroyed, but as wealth changing hands. When the tide of the economy recedes, it exposes who has been building on solid rock and who has been building on sand. The assets, the stocks, the real estate, the businesses, they don't simply vanish, they are relinquished by one group and acquired by another. This great transfer flows from the emotional to the disciplined. The emotional investor acts on impulse. They are driven by the panic of the headlines and the fear of seeing their portfolio value decrease day after day. Their decisions are reactive, not strategic. They sell when their fear is greatest, often at the point of maximum financial loss, crystallizing their paper losses into real ones. They abandon their long-term plans at the first sign of trouble, convinced that this time is different. They are caught in the storm without an anchor, tossed about by the waves of market sentiment. The disciplined, by contrast, operate from a pre-established framework. They have already stress-tested their portfolio and their mindset. They understand that volatility is the price of admission for long-term returns. When others are panicking, they are consulting their plan. They see falling prices not as a catastrophe, but as a discount, a sale on the world's greatest assets. Their discipline allows them to execute their strategy unemotionally. Whether that means holding firm, rebalancing, or methodically buying assets at prices they could only dream of months earlier. They have mastered their own psychology, and in doing so, they position themselves on the receiving end of the transfer. The transfer also flows from the unprepared to the patient. The unprepared are those who are caught off guard. They have no emergency fund, they are over-leveraged with debt, and their income is tied to a single, vulnerable source. When the recession hits and jobs are lost, they are forced into survival mode. They must sell their assets, not because they want to, but because they have to. They sell their stocks to pay the mortgage. They sell their home to cover their debts. They liquidate their future to survive the present. They are forced sellers in a buyer's market, the weakest players at the table. The patient, however, have spent the sunny days preparing for the rain. They have built liquidity. They have managed their debt. They have diversified their income streams. Their patience is not passive. It is an active, strategic stance. It is the strength to hold cash while others chase fleeting gains in a toppy market. It is the fortitude to wait for the precise moment when fear has peaked and opportunity is greatest. They are the buyers of last resort, providing the liquidity that the unprepared so desperately need. They exchange their cash, which is abundant in a crisis, for assets, which are scarce and undervalued. Their patience is the weapon that allows them to capture decades of wealth in a matter of months. The stark reality is that most people won't change. The lessons of history, though clear, are often ignored. The cycle of fear and greed is deeply ingrained in human nature. The majority will continue to buy at the top, fueled by FOMO, and sell at the bottom, crippled by panic. They will remain unprepared for the inevitable downturn, hoping it will never come. This is not a judgment. It is an observation of a pattern that has repeated for centuries. The path of discipline, patience, and preparation is simple, but it is not easy. It requires swimming against the current of popular opinion and mastering one's own primal instincts. But those who do change, those who internalize these lessons and commit to a different path, do not merely survive a recession. They emerge stronger. They are forged in the crucible of the downturn. They have stress-tested their financial foundations and their emotional resilience. They have acquired assets at bargain prices, setting the stage for generational wealth. They have learned the true meaning of risk and opportunity. They come out the other side with a more robust portfolio, a deeper understanding of how the world works, and the quiet confidence that comes from navigating a crisis successfully. They are the proof that adversity is the greatest catalyst for growth. History is clear. From the tulip mania of the 1600s to the dot-com bust of 2000 and the global financial crisis of 2008, the story is the same. Each crisis was decried as the end of the world, yet each time the markets recovered and went on to new highs. And in every single instance, a massive transfer of wealth occurred, from the panicked and unprepared to the patient and disciplined. The data is unequivocal. The pattern is undeniable. Therefore, the question you must ask yourself is not an abstract one. It is not about complex economic forecasts or trying to predict the exact timing of the next downturn. The economic cycle will turn. A recession will come. That is a certainty. The only real question is who you'll be when it does. Will you be the emotional, unprepared seller, forced to relinquish your assets at the worst possible time? Or will you be the disciplined, patient buyer, ready to seize the opportunity of a lifetime? The choice is yours, and the time to make it is now.